How you doing? Phil Kane here, Managing Partner, Rush Street Capital. I'm here with Jeffrey Quinlan.
Hello everyone, how's it going?
Jeffrey, Associate here at Rush Street Capital. And also, we have a live feed from the rest of the team right here. How about it? With the wonders of technology, Rick Lopez, James Sheehan, Patrick Kelly, all here. Reporting live from the Rush Street offices here in Chicago, Illinois, right before Halloween. We are going to talk a little bit today about the process of raising capital, but more focused on the back end of the process. So in raising capital, our opinion is that 90% of the focus really is spent on the front end of the process, where you begin talking to capital providers, equity banks, lenders, mezzanine firms, finance companies, and you collect term sheets, you see if they're interested, and that seems to be 90% of the effort and the focus. But in fact, even when you get to the point where you've selected the capital providers, you're really probably not even halfway through the actual closing process. So, Jeffrey, want to talk about that a little bit and kind of some of the things you've experienced here?
I would say the biggest theme coming out of that, and what you're getting at, is really this idea of endurance. You've got to work through not only that beginning portion, but then everything on the back end, and this idea of certainty to close and speed really starts to come in the longer these deals are around and you're working on it. Just more opportunity, not for necessarily something to go wrong, but just more uncertainty to be interjected in the mix. So when you're, say it's only halfway with getting the term sheet, I think it's really true in just speaking to all the other things that you have to work through with the lender, legal counsel, to finally realize, oh, this is the path to a closed deal, and then getting that funded.
Yeah, you think about some of the things that go on in that process, right? What we like to tell people is that it's like a Rubik's Cube. It's a combination of several different processes all together, intertwined. And a lot of people don't realize that. It's not just underwriting the loan. It's not just proving out the investment thesis. It's not just getting to know the business. It's all of the financial due diligence, which involves the accounting of the business, asking in-depth questions about the company's business, possibly talking to customers or finding out the stickiness of those customer relationships. It's proving out the margins that the business earns. And all of these things are happening while the management team's running a business. They still have a business to run. And then you have the law firms with the legal documentation. All these things that are intertwined and happening at the same time. And at any point, if there's a hiccup at any point in that process, it can kind of send the whole thing back to the beginning or disrupt the whole process. So these are some of the reasons why people that don't do this every day don't realize how complicated it is and how long these things can take and how much precision goes into it. So that, and I know you've commented many times since you've been here about how shocking that has been for you to realize just how many things go on during that process and how many things can go wrong.
Just easy example is just thinking through of getting a mortgage or something like that for yourself, how much the bank has to learn about you. It's like really bringing in, we say a partner, but it really is. They've got to be a partner with you in the process, and they've got to know everything and stuff you don't even think about knowing. It's got to be not uncovered, but it's got to be learned and understood and worked with before someone gets comfortable spending the next 5-6 years with you as a lender.
Yeah, it is really labor intensive. It's a lot like building a house from scratch. So there's a lot of grunt work, a lot of very heavy, intense, and labor intensive things that have to go on. So that was one thing we wanted to talk about, and then also wanted to touch on kind of what's going on in the market as we are deep into the fourth quarter now. It's November 2018. Jeffrey, what are some of the things that you're seeing out in the marketplace? Some
Sure.
of the things that are happening now.
Yeah, so as everyone's seen with the market to start October, it's been a rough start. It's not totally unexpected given how calm and the stock market's been for, I would say, the past year, but we're starting to see the effects and uncertainty surrounding the tariffs. And if you read much of the newsletter, you're seeing just how those effects could flow through the economy. And now it may be shifting over to business and consumer sentiment as far as who they like politically, how they're going to spend, how they're going to react for the rest of the year and into 2019. I know one thing we always harp on, and not to be a hairbringer, but rising debt levels. It gets to a point where even though we have growing GDP, how much more debt can you add on? If interest rates come above growth rates, then you start to run into issues.
Jeffrey, are you saying that as interest rates go up, you have to pay more?
Unfortunately, you
what?
do. It just
and that actually affects things? Oh my God! What a shocker! Yeah. So a lot of times people forget these kinds of things, right? Low rates stimulate economic activity as rates rise, and the problem is markets are forward-looking, right? So they don't just live in the past. That's absolutely not what they do. Market participants, they like making money and they make financial decisions and everybody's acting in their own economic self-interest. They're forward-looking. So if rates start to rise, people are planning on them rising more.
Yeah.
They start to make decisions about that. They start forecasting differently. Lenders, borrowers, companies, everybody. So those are some of the things that are taking place. However, still plenty of lenders out there, right?
Still very
In fact,
active.
Our opinion, what we experience every day is there's a plethora of lenders. There are more types of lenders than ever before. Private equity funds that are now lenders and mezzanine debt firms that are now private equity, banks who are lending cash flow loans, asset-based loans, all kinds of different types. It's very confusing. Helping people navigate all that is a lot of what we do too. It can be really overwhelming. A lot more options, which can often, as a borrower in a tight time frame, can be more confusing. So we live in those markets every day. That's what we do. So Rick Lopez, you want to say a couple things to the folks? Say hello.
Yeah, just reiterating those points, especially given the macro dynamics that we're seeing in the market, helping navigate the process, and especially just knowing who to go to in what circumstances, because as we all know, no two credits or transactions ever look the same.
Very true.
Being in the capital markets daily, that's really where we're focused and
All right. Well, thanks. I think we're going to leave it there. Thanks, everybody. Enjoy the fourth quarter. Cold weather coming. It'll be Thanksgiving before we know it. Still time to get a deal done before the end of the year, but it's getting pretty close now. So, all right. Thanks, everybody.
Take care.
We'll see you next month.